Hi, my name is Eric Burkholder with Burkholder Wealth Management, and we're recording this video today to talk about two things. One is the very recent events going on in the world right now in the stock market, and then two, what, if anything, you should do with your portfolio given the current events. So first is the obvious news I think everyone's aware about. Massive across-the-board tariffs were announced yesterday from the Trump administration. Today, the market is certainly not taking that news well, and I don't want to give you an economics lesson today, but I will just point out a few things. One of those being that pretty much universally economists don't think tariffs are a good idea. Certainly broad sweeping tariffs across the board are not good, and we have some very good examples in history that really show this to be true, and the most obvious one was the Smoot-Hawley Tariff Act implemented in 1930. We don't need to get into the details, but this was running up into the Great Depression. There were some thoughts that if we implemented tariffs, it would bring back manufacturing and goods to the US. That would help us get out of what was looking to be like a pretty severe recession or depression. Tariffs were implemented on about 20,000 goods imports to the US around that time, and initially did seem to maybe be working. There was a pickup in manufacturing in the US, but we all know the history. It did not end well. Other countries implemented retaliatory tariffs. Imports and exports decreased over 60%, and global trade decreased over 60%, and really just drove the US into a deeper depression and was not good. It's used as a case study in economics classes about why tariffs don't work. And so we have a lot of historical data on why free trade is good in general. Certainly the US has benefited from free trade for decades. It's coincided with the incredible wealth and growth in our GDP in the US. So that is a background, and that is why markets do not like the tariffs that were announced yesterday. Certainly the market's very red today. Not sure when that will end, but more importantly, we want to talk about what should we do? What, from an investing standpoint, whether you're retired or saving, is there anything we can do or anything we should do in light of this new information? And I would say this probably won't shock you, is that you really need to stick with the plan that you've created. The whole point of having a plan, having a diversified portfolio, is to be prepared for uncertain events. Certainly, these tariffs, the extent that they've been implemented, would have been very hard to pick on the bingo card for 2025. But we know that global events happen. They've always happened. And a trading strategy around those events is extremely difficult to implement. If you're a day trader, yes, go for it. There's probably a lot of moves you can make. But when you're building wealth, you're saving for retirement or in retirement, we are creating portfolios with as much diversification, as much tools and levers in there as possible to be prepared in advance of an event like this. So a prime example is international diversification. We've talked over and over again in many videos about the importance of international diversification, despite the US having done extremely well the past 10 years. Right now, and I don't know how today will end, but through yesterday, the US international markets were up 6 or 7%, and the S&P was down 4 to 5. And so just there, you can see by owning not just US markets, you're really cushioning what could be a really bad year so far. In fact, through yesterday, again, this will probably change after today, a lot of our portfolios were still flat to slightly above zero return for the year. And that's really the best thing you can do, is to have a portfolio designed to work in as many environments as possible. We cannot prevent downturns. We cannot prevent your portfolio from being negative. But the more we can build in protections, the more diversification, the more that portfolio can be designed for your specific life circumstances, the better you're able to tolerate these major market movements, come out on the other side in good shape. And so, if you're saving for retirement, obviously this is going to be an opportunity to put cash to work. We're a big fan of dollar cost averaging. So as these markets move, especially if they continue to move down, if you ended up with some cash on the sidelines that you haven't been investing, it might be a good time to start putting some of that to work. If you're retired, obviously this comes into how we designed a portfolio for a retiree. You should have cash, you should have short-term high quality bonds. There's alternative investments that often are positive during times of market turmoil. There should be enough levers in that portfolio, again, to continue to provide that monthly income you need and allow us to ride out the storms in the market. And that doesn't require us to predict what's going to happen. That just requires us to put together a good portfolio. So there's rebalancing that can be done during times like this. There's certainly tax loss harvesting that can be done, which is the subject of another video. The glass is half full. There are things you can do, but certainly panicking, selling out of the market, we know over and over again that ends up increasing your risk and lowering your returns. So I don't mean to downplay what's happening. I would just say that large worldwide events do happen. We have seen them throughout history in the markets. Even in more recent history, we had obviously Russia invading Ukraine. We had the global COVID pandemic. I mean, we've gone through some major world events. They were scary, markets were volatile, but we can even look back on those recent events and see the plan that worked best for investing was to be disciplined and have a strategy in advance of those events. Making trades or rebalances or changing your portfolio based on your individual circumstances, not what's going on in the markets. That's a long answer to say there's nothing specific I would recommend anyone doing today. It's very likely you'd end up getting whipsawed by the market, trying to predict what's going to happen. Use this as an opportunity to review your portfolio. If you were underweight international, I would certainly say this is a good time to review that. If you were, had too much equity exposure, it would be a good time to review your risk tolerance and see is this the right position for you to be in. And if you were too conservative, honestly, this is an opportunity for you to get a little more aggressive. Like I said, we're big believers in value investing and buying when things are down, and so this is an opportunity. It is scary. It doesn't feel good, but there is opportunities. And like I said, a good plan will survive what's going on. So in recap, 1, tariffs are not good. That is not a political statement. That is an economical statement. That does not mean we have to panic sell the market. We need to make sure we have a good plan, and this is a perfect time to review your plan. So if you have any questions, if you want to review your plan, we're happy to talk with you. And we'll be here monitoring your portfolios, monitoring your situation, and making sure you're in a good shape as possible given what's going on in the world. So hopefully on the next video, the market will be not so red and we'll have turned a corner. But we will see. The world is uncertain, and that's why we have a plan. So thank you, and we'll see you on the next video.